What we're going to talk about today is the correct terminology when it comes to financing, in particular, mortgages. There are two basic theories to financing in this country. But as far as New York is concerned, we subscribe to what's called the lien theory for financing. In a lien theory state, we have a two-party, two-instrument transaction. We're going to talk about what the two parties are to a mortgage transaction. You have a borrower, you have a lender. In terms of mortgages, the borrower is always referred to as the mortgagor, and the mortgagee is referred to as the lender. So I have what's called a OREE rule. What that means is that words that end in OR are the owner givers of whatever is owned and being given. Therefore, words that end in EE ultimately are recipients. Many people think the mortgagor is the lender, and that is just not true. And the reason is, it's only the borrower that can post collateral. So let's start there and say, what is a mortgage? A mortgage is collateral in very simple terms. And what it does is it securitizes the note, which is the evidence of the borrowing that you signed. Think of it like an IOU. So in order to put something of value behind the IOU, the borrower signs the mortgage, gives it to the lender, and the lender has that as a security interest in the property. What is a note? A note is the actual evidence of the borrowing. It's considered in law, it's considered as prima facie evidence. That is a legal term to suggest on face value. There are not many defenses for a note other than that the signature on the note is not yours, or that it has been modified after it was signed. But if you were the one who signed that note, then you owe the money, which is what we mean by prima facie evidence, you know. So what the mortgage does, and the reason why the lender lends the money, is because it collateralizes the note, where they actually realize they're going to get their money back. And if they don't, they will take the property back in order to satisfy the terms of the unpaid portion on the note. Do lenders give mortgages? Well, I think we've just answered that by saying that if we're putting up collateral, who puts up the collateral? Well, the only one who can put up collateral is the property owner. So really, the property owner gives the mortgage in exchange for the bank giving them the loan. So banks do not give mortgages. Only property owners give mortgages. At the end of the day, it acts as a security interest for repayment on the note.